Welcome back to the What's More podcast. I'm your host, Quinton Harris. You are dialed in for episode 169. It's going to be an exciting one. We're going to talk about two things. Number one, I was speaking to someone who was a listener the other day. It was kind of cool when you have conversations with people that listen to the show and they're like, hey, Q, I love all the stuff that you're dialing in here, but I also like it when you guys do some cool inspirational stuff. So I'm going to start with that this morning, and then I'm going to jump into a Friday data point that came in this morning here, and what that means for the markets, what that means for the mortgage market, mortgage rates, industry professionals, and what the hopes were and what reality is here right now. So let's start with the quick inspiration thing. So I'm talking to this listener is like, hey, I like it when you have cool inspirational stories on there. I love the market stuff, but if you could add a little bit more of that, I'd appreciate it. So, Marcus, this one's for you, buddy. So if you're listening to this, you'll kind of know where I'm going because we talked about this on the phone. But, what I would love to hear from our audience is this. We talk about what's your one more all the time. And we talk about what's your one more growth, what's your one more inspiration, what's your one more market move, what's your one more thought process. And what I've always wanted to do with this show, dating back to when we first came up with it, my children and my wife and I and my friends, we had this concept of what's your one more? And so what I want to do is this. I want to hear from the audience this, and this is the inspirational part. Would this be appealing to you or to your friends or to your community if inside this show, we don't just talk about things to look for and break down, news headlines and debunk them, but we actually start to empower you with information, but I also want to make an incentive for this. What if we could make your car payment for you? And let me dial in a little bit more about that. What if we said, hey, listen, all we're asking is this: go to our YouTube channel at What's Your One More, subscribe, leave a comment, and inside that comment, what I'm looking for is I think the car payment would be a really cool idea. What I want to do by the end of the summer is start a monthly campaign to where we draw from the list of our subscribers, and we're going to bring you on the show live, and we're going to Venmo you or we're going to PayPal you your car note. That's what we want to do. And we're prepared to start doing that by the end of August. So I'm going to start talking about this more in the show because I want to gain some momentum, but I want to help people. That's the biggest thing. The whole purpose of the show was to help people. Now, we don't have a sponsor for this yet. That's going to come out of What's Your One More's own pocket here, but it's something that we want to start. We'll eventually get a sponsor because this is going to be something that grows bigger than this, but we want to give back. That's going to be our inspiration to the audience. It's going to be a daily inspiration on every show that we talk about, and every month we'll pull that. And you just give us your car payment. We'll make it. Show it to us, email it to us. Once we draw your name, boom, we'll bring you on the show. We'll do this and we'll make a big deal about it because that's something that I think is cool. It's going to help people in this economy that we continue to talk about that's not as good as what we hear about all the time. And we want to help with that. So that's going to be our inspiration to start the day. So if you like that, go to our YouTube channel. What's Your One More? Leave a comment. Say, hell yeah, I'm down for this. Yes, please include us in the drawing. We're all for this. Get people to sign up. Tell people about it. It's going to be something that's very cool and unique. I don't know another podcast that's doing something like this. And when we get a sponsor, who knows? It may do more than one car note, or it may turn into something much larger. That's the goal here. So if you know someone that would like to participate in that, let us know that as well. You can go to our website, email Charlie, my producer, or myself. Let us know. We'll also be searching for ones to participate in that hopefully we can change some people's lives. All right, let's go right into the show here. So as we start and kick off the show, we've had a huge last 2 weeks, and the bond market has rallied tremendously up and down, but it's been very resilient. Why, Bill? Because the inflationary data that came in over the last 2 weeks has been awesome. You've had the CPI data come in, which is check, in point, or lower. You've had the core come in lower. You've had the core PCE come in lower. Everything has been lining up. So that's what made this week so weak, because it was jobs week. And what I mean by jobs week is we get reports from ADP, which is the private sector, and then we get reports from the BLS, which is essentially the government sector, right? And inside that, we also get what we call job openings. They're JOLTS reports. And then we also get initial jobs loss claims reports every Thursday. So all this job stuff was landing on the same week here. What's interesting is this. Lower than expectation is good. Lower than expectation is good, meaning that if the job reports are saying, hey, we expect this, and it comes in lower, that means less jobs were created. Now, why is that good? Well, because that shows an indication of a softening labor market. And as we talked about over again, that's what the Federal Reserve wants to see. That's what the Federal Reserve needs as an indicator at this point to go, hey, listen, maybe it's time to start taking our foot off of the brake here and start lowering the rates. Now, when I say the rates, the Fed funds rate, right? So let's just take a look around the global economy. What happened here? Well, it's interesting. Yesterday, we had the ECB, which is the European Central Bank. We had the Bank of Canada. Both large central banks came out and said, hey, we're going to start cutting rates. Now, they were the first to the party to do it. That type of momentum definitely gave us some sort of okay, maybe we're next, right? Not that we follow the country's leads, but if the indicators are falling in line, it makes sense, right? So as I mentioned, CPI, which is the consumer's basically form of inflation index, came in below expectations on the core, which is a win. The PCE, which is the Fed's foreign favor inflation, it came in lower than expected. All of this was a win. So going to this week is a huge week. ADP, which is, we all know is a private payroll company, that came in lower than expected, right? So now everything's checking the boxes. The JOLTS reports, they came in lower than job openings came in a poorer reading, if you may. That's a win, right? Less job openings equals lower equals better for rates. That's just how it is. Less jobs are being created. So all eyes were on this BLS report that just came out as I'm doing this podcast. It literally just came out 8 minutes ago. And my producer, if he was on the show, would tell you how deflated I was when that came in, because it came in at an astounding 272,000 basically non-private payroll jobs created when the expectation was 185. That's a swing and a miss. Like, that's not good. That's unexpected. And I haven't had a chance to read the whole report yet, but I can guarantee you when I go through it, the bulk of that is going to be government-created jobs. It's also going to be people that are having second jobs. These are part-time jobs. These are not full-time jobs, because those private sector jobs are the important ones. Those are the ones that are driving the economy, not this. Unfortunately, though, the markets are moving in a negative way on this report. And I think as it has time to digest, it'll kind of subside itself. But this is not the momentum we wanted. It's actually the opposite of the momentum that we wanted. And this continues to be such a letdown indication for basically the real estate community, right? Because this is everything else. All the important things were checked. And for it to come down to this last thing and this happened, it's just like, ugh. Now, there was one shining light in this report that I've already gone through very quickly. Unemployment was up 4%. By no means are we cheering people to lose their jobs. That's not what we're saying. What I'm saying is we know people are losing their jobs. We just want the reports to be more accurate to reflect the amount of people losing their jobs so that the Federal Reserve can also see that accuracy, and so that the markets can see the accuracy. And the unemployment jumped from 3.9 to 3.8. Or excuse me, 3.9 to 4%. It was 3.8 2 months ago. So we see a constant rise in the unemployment number. Why is that important? Well, we know, and we've talked about it, that 17 of the 19 FOMC members, that's the Federal Open Market Committee, the Federal Reserve, essentially, they do not want to see this number with a four handle on it. They have warned and they have said, hey, listen, that's a concern. Matter of fact, 11 of the 19 said 3.9 is a concern. Now, the range was 3.9 to 4.1. We're right in the middle, which you could argue simply that the majority of the FOMC members are concerned with this number. Is it enough to get their attention into this next meeting? I don't think so. I think if you go through all 7 checkpoints, this one right here may be the one that holds them back from making a rate cut. I think they're going to sit there and pause again, unfortunately, because of this report, even though I think this report is a mixed bag of numbers when you break it down. And I haven't done it yet because we're doing this live as it just came out. But again, I do know this. I did see the revision from the previous month, and it was a downward revision. Again, a downward revision. This is the theme that we've seen over the last 14 months, being a downward revision, which means I post a big number, and then I come back and I go, well, we're actually going to revise that to a lower number. And so this is the theme. And so when I see 272, the question is, what really is that number? Next month, when I get the revision of this 272, is it actually going to be down to the 185, which was expected, or less? And unfortunately, the market can't digest that now because they won't know until 30 days later. And that's the problem with this particular sector. And we've been saying that on the show for quite some time. I just don't think it's going to be enough for the Federal Reserve to make a decision to say, hey, listen, let's go the other way. And what really is kind of unfortunate about this is the downward pressure that the 10-year was making because of all these other indicators coming in line, finally in line, was we gained significant headway on the 10-year Treasury, which represented significant headway on mortgage rates. And this could have been the one that kind of pushed it over the cliff a little bit. Now, the reason I'm saying that is continue to say the Federal Reserve doesn't need to cut rates for mortgage rates to come down. They don't need to do it. The 10-year Treasury just has to retreat, and it was doing that. Now, with this report coming out, we've seen an uptick. It didn't wipe out all the gains we've had over the last week and a half, but it definitely has taken a good chunk out of it. And, and I'm just thinking the entire time, go back to that conversation. Daniel and I were in a fireside chat with Atlanta Federal Reserve President Raphael Bostic, who, by the way, I have invited on the show. And for those listeners, I've got a response. They're actually trying to schedule a time to get him on here. That's going to be a great interview, by the way, if we get that, to get the Atlanta Federal Reserve President Raphael Bostic on here. And I'm looking forward to that because he is a very witty, intelligent, and humorous person, by the way, in some of his interviews. But, it just bodes the question. Like he said, I don't see us cutting rates until September unless there is a softening in the labor market. I mean, when we were listening to that fireside chat with about 60 other people, that was right on the heels of the CPI, right? And as I said, it came in lower. So he was very happy to have this conversation. But what hadn't happened at that time was that the PCE, which came out the next week, which is the big one they check, it came in lower. And so all of the indications were coming in lower, which he had basically said, we want to see further indication that it's getting better. We need to see multiple layers of indicators. Well, they were all there this week until this report came out. And so he said softening of the labor market. Now, I had a question that I planted that hopefully he would answer, and we didn't get a chance to do it, but we'll ask him on the podcast, is what did unemployment rate need to get at for him to go, yeah, we may have gone too far? I'm willing to bet it's 4%. Maybe 4.1. That's right where we are right now. So there could be some sort of pause there that makes them go, yeah, maybe we should look at doing something here, because the ECB and the BOC have already done it as well. Now, they may do it for different reasons, but the reality is there's still a chance. But this did not help. This did not help today, and that's unfortunate, because I was really asking myself this question as I drove in here this morning to do this podcast was, are we getting that cycle? And if you look at the chart that Charlie has put in our YouTube channel multiple times, and I'll have him put it in this one as well, election year rates, right? Election year results. Because typically what we see is a pullback in the market leading up to an election, in the real estate market specifically. And we see this dip in transactions to where people are just hitting the pause button because, hey, I'm kind of uncertain, I'm feeling some kind of way. And while that's your own personal, you can do that, right? It doesn't make sense to me, but you can do that. And I see it happen. It's like a huge drop off. And then after the election, there's a sigh of relief because you kind of settle into whoever won, real estate transactions shoot right back up because everyone's rushing to get into the home. Well, we're in a season right now where we should be peaking, right? June should be the peak of the real estate market. Maybe you could argue July. Well, it appears on paper right now that March might have been that peak. Just based on transactions alone, you see March currently is the peak month, which bodes the question, why are we not doing so well in the summer months? Because that's really the run-up. That's the cycle of seasonality that happens here. And you could argue it's because the rates are far higher this time, at this point of this year, than they were last year. And last year was a high rate cycle. So why are we there? And it's because of this contraction that's happening in the 10-year Treasury, and the Federal Reserve just staying consistent right now, and no one can time the market here. And so we're seeing this fluctuation in the rate, and the consumer is the one that's backing up and saying, well, I mean, hey, maybe I just wait this out till I can get some level of affordability, right? Till the affordability gets in line. Because what's happening is even as the rates are going up, the home prices are going up too. I mean, the national average is 5% right now. And so nothing is retreating towards the consumer or the buyer's favor right now. The home prices aren't coming down and the rates aren't coming down. So I think until we see some relief in those rates, that's going to continue to pause on the real estate market in this level that we're at right now. Now, I do think that by September, it's going to get better. It's just that between now and then is this level of uncertainty. And unfortunately, I really thought I was coming in here this morning. I mean, again, Charlie can attest to how kind of like, it was when this report came out, because I was coming in hot today, ready to go, like, here it comes. There was a part of me that knew this could happen, but I didn't think it would be like this. I didn't think this would happen after all the other indications. And to see the 4% of unemployment go up tells me that, all right, this job creation, if you may, on the BLS side is BS. They should just remove the L and call it the BS report, because that's exactly what it is right now. Because for 14 months in a row, it's done nothing but let us down, downward revisions, pump up the false narrative that these jobs are created. Because why? We're going into an election year and no one wants to talk about the lack of jobs being created, when the reality is unemployment is going up. Continued claims, which that's how many people are getting unemployment, is going up. And the private sector has showed jobs going down to the tune of negative 30,000 in comparison to the previous expectation. So this should have the L removed. And for this podcast, I'm going to say that's the BS report, and definitely don't think that that's fair to the markets and how things has. But anyhow, let's go back to that inspiration thing that Marcus talked about. I want to do, hey, again, if you like what you're hearing, share this podcast. Please review it. Please 5-star it on Apple, Spotify. If you're not a YouTuber, but I want to hear your comments about what do you think about us making that car payment for our audience starting the month of August all the way through the duration of the podcast. Leave a comment in Spotify. Say, yeah, man, plug me in on that. Leave a comment on Apple. When you 5-star review this, we'd love to hear about it. But YouTube, go subscribe. I cannot stress that enough, because that's where this whole thing is going to take place. That's where the entries are going to take place. And we look forward to doing that. I think it's going to be a super cool moment. I hope to see you on the show, and I hope I draw your name name, and I hope we can make your car payment for you heading into August here. Guys, have a wonderful weekend, and if you're listening to this, I think it drops on Monday. Have a wonderful week. Till then, we'll see you at the next episode at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live.